What if the one decision you'll make this year that could secure your retirement is also the most boring? For the past year, every investment has felt like a high-stakes gamble. The financial world is screaming about AI, crypto, and the next big bubble, forcing you to choose between the sheer terror of losing everything and the agonizing panic of being left behind. You're desperately searching for a safe place to put your money, but every conventional source offers nothing but fear or negligible returns, trapping you in a cycle of anxiety. We're going to stop chasing the next hot asset and start building a tiered defense system designed to protect your hard-earned wealth, not just from the market's chaos, but from your own entirely human fear. Every truly successful financial life begins with an utterly impregnable base, a reservoir of funds that exists for one purpose only: to absorb the shocks of an unpredictable world. This initial step is about securing your ability to sleep peacefully regardless of the day's headlines. This is your emergency fund, and its primary job is not to grow your money, but to prevent you from ever becoming a forced seller. The panicked investor who is compelled to liquidate their long-term growth assets at a loss because a sudden emergency left them with no other resource. The core conflict in finance isn't the market versus your portfolio. It's your own financial reality versus unexpected life events. The essential but unconventional rule here is to set your emergency buffer at 6 to 9 months of your essential expenses, pushing past the commonly cited 3. Why the longer runway? Because modern economic downturns can be deeper and last longer than traditional models ever predict. And that extended time gives you the ultimate psychological advantage: optionality. That extra quarter or two of living expenses buys you the most precious resource in a crisis time. It gives you the time to negotiate a better job, the time to retrain your skills, or the time to patiently wait out a severe market crash without having to touch a single asset meant for the future. This cash acts as your shield against the intense, primal anxiety that drives poor decisions. It deserves to be held in the safest, most instantly accessible vessel possible, specifically a high-yield savings account, HYSA, or a money market fund offered by a reputable brokerage. These are entirely predictable, which is exactly the point when your world feels anything but. This money must feel boring because its absolute purpose is to be entirely dependable when everything else is shaking. And by committing this cash to the foundation, you eliminate the single greatest threat to your long-term success: selling at the bottom. When you know your life expenses are covered for nearly a year, you gain the clarity to look at a market crash not as an existential threat, but as an actual, genuine sale. Once your zero-risk emergency cash is funded and utterly secured, you will likely have additional capital designated for known big-ticket expenses coming up within the next 1 to 3 years, perhaps a car purchase, a house down payment, or a major planned renovation. This capital is far too important for the long-term, multi-year volatility of the stock market, yet it's a profound waste to let it merely sit stagnant at anemic interest rates. The challenge is finding a way to earn competitive, predictable returns without sacrificing the important element of certainty for the moment you actually need to access the funds. This is where we stop thinking about growth and start thinking about guaranteed maturity. The best solution is to execute a CD/bond ladder strategy, one of the most effective yet most underutilized conventional tactics that expertly blends liquidity with higher rates. Instead of locking all your short-term savings into a single long-term instrument, you strategically divide the cash into several segments. You purchase a mix of short-term government debt, known as Treasury bills, T-bills, maturing in 4 weeks to 1 year, and certificates of deposit, CDs, which are fixed-rate agreements with a bank for set periods like 6 months, 1 year, and 2 years. The true genius happens when you introduce the laddering technique. You split your capital, perhaps into 3 equal parts: a 6-month CD, a 1-year CD, and a 2-year CD. When the initial 6-month product matures, you don't spend the money. You immediately reinvest and roll that cash into a new 2-year CD. This creates a powerful, continuous cycle, meaning that every 6 months, a portion of your cash automatically becomes available for your tactical needs, while simultaneously allowing you to capture the higher, fixed rates usually offered by the longer-term commitments. T-bills, being fully guaranteed by the government and often exempt from state and local taxes, further enhance this tier's effective yield. Your short-term goals are now protected by an iron shield of predictability, and the way is cleared to confidently deploy the rest of your capital into the true engine of long-term wealth creation. Your fortress is built, but now we must arm the core equity tier, the weapon designed for generational wealth. This is capital you commit to the next decade, a non-negotiable term because only time converts daily market risk into a near certainty of superior return. The goal here is not stock picking, it's owning the relentless, unstoppable engine of the global economy itself. We achieve this with the 3 things. These are 3 low-cost index funds within a tax-advantaged wrapper. First, the Global Market Fund, the anchor, removing the disastrous risk of being wrong about any single country. Second, the U.S. technology driver, the accelerator, an intentional bet on the world's most dominant innovation hub. Finally, the emerging markets small cap fund, the wild card, a small, volatile allocation ensuring you capture high-growth surprise returns when the leadership baton inevitably passes. This system is the safest, most powerful bet you can make on the future. While your core equity tier is perfectly designed to grow wealth during periods of relative stability, a truly safe and resilient portfolio must account for 2 extreme, low-probability scenarios that can instantly destroy purchasing power: runaway inflation or sudden, crushing deflation. You need dedicated assets that are structurally designed to perform well when paper money loses its value or when traditional financial systems suffer a severe, system-wide shock. This is your crisis buffer, and it serves as the ultimate insurance policy against the economic extremes. The solution is to acquire dedicated assets structurally designed to thrive when the traditional financial system suffers a severe, system-wide shock. First, you need a small, consistent allocation to physical gold, or an ETF tracking it. Gold is the ultimate fear asset. It generates no income, but in moments of geopolitical crisis or extreme monetary devaluation, it provides a safe, historically reliable store of value that exists inherently outside the financial system. Second, you must hedge against your own government's potential monetary errors by looking at Treasury Inflation-Protected Securities, TIPS. These specialized bonds are contractually guaranteed to rise in value with the official inflation rate, ensuring your purchasing power is protected even when traditional bonds collapse. By allocating a small, specific percentage to these 2 non-correlated assets, you introduce a layer of diversification that is protected by design. When the market panics due to inflation or geopolitical turmoil, these specific assets hold their ground, completing your defense system with intelligent, non-conventional safety. The final, most crucial place to put your money is not an asset, but your own cultivated behavior. All the technical strategy we built, the ladders, the index funds, the hedges will collapse instantly if you panic. The safest asset you will ever own is a disciplined mind. Because the largest, most devastating losses never come from external events. They come from your emotional reaction to volatility. Your ultimate goal is to build behavioral alpha, the superior return you generate simply by not making mistakes. This means training your mind to look at a 15% portfolio drop and feel nothing but curiosity. The ability to sit still when the world is screaming is worth exponentially more than any insider tip. You must internalize that market volatility is the entirely normal, expected fee you pay for superior long-term returns. This week, write your investment policy statement, IPS, a one-page document written when you are calm, outlining when you are allowed to sell. Only for life changes, not market swings. Sign it, laminate it. This final layer removes the impulsive human from the process, ensuring your success is dictated by plan, never by panic. Secure your future in the 6 inches between your ears.